Hi everyone, my name is Puyan Lau. I'm the VP of Sales in World 82, Team 3. Today I'll talk about the operation and product management compared with our 2-year plan in year 5 and year 6 with our actual data in both years.
Hello, I'm Jessica Bermudez, and I'm VP in Accounting, and today we're going to be discussing the variances in our financial statements.
Hi, I'm Justin Ham, and I'm VP of Finance.
Hello, my name is Jose Mejia. I'm the VP of Marketing for Pacific Goods. I will be going over the SWOT analysis, Year 7 projections, the lessons learned, and also the conclusion.
My name is Angel. I'll be talking about the company's functional strategies plan.
Hello, I am Irving Chavez. I am CEO of Pacific Goods Incorporated, and I will be talking about performance targets in this section. Pacific Goods Incorporated was a company with huge growth potential. Since the beginning of year 4, we decided to open up a plant overseas and get the jump on the industry. This pattern of expansion continued as we moved on to years 5 and 6. Our company has had the highest total assets in the industry for almost the entire period. In order to make these investments worth it, we needed to make big profits to keep our ROA high. When we did the 2-year plan, all previous reports had shown our ROA to be relatively small. It wasn't until the construction was over and our operations got smoother that we saw a huge spike in ROA. By the end of year 4, we had an ROA of 14.5%, and that again jumped to 17.31% by year 6. We're very pleased with this, especially considering how big our assets are in total. It is good to know that our investments have paid off so well in the last 2 years, and we expect that number to keep going up in the following years. Our company started to produce high levels of net income as soon as our overseas plant was up and running. This allowed us to cover most of our expenses with our current cash flows. In order to build that plant, we took on some long-term debt to fund it. We had $4 billion in bonds outstanding by the end of year 4. Since we had more cash available now, we decided to start repaying this throughout the following years. We currently are on a program that buys back bonds at a rate of $1 billion of bonds per year. Even though our long-term debt has decreased, our ROE has risen beyond our original expectations. ROE was over 18% higher than expected in years 5 and 6. We do not want to operate on too much debt, so we shall continue to reap the repayment plan, but we try to keep our ROE between 15 and 20% for the following years. Pacific Goods Incorporated had a mission of being an excellent provider of a stable product. We wanted to have a reliable price point with moderate features that our customers would enjoy. Our industry was very volatile from the beginning. We experienced massive price drops from our competitors, so we decided to follow our strategy and keep ourselves stable while everyone else continued to change prices every quarter. After year 4, we noticed that all these price drops were helping other companies take a bit of our market share. We tried to hold off and just increase our advertising to keep up, but it was futile. This definitely got in the way of our predicted market share for years 5 and 6. We were short 6% of market share by year 5. Entering year 6, we decided that we had to address the price wars in order to regain our market share. We lowered our prices in order to be more competitive, and it had great results. By the end of year 6, our market share was 22.9%, only 3% short of what we had envisioned. We believe that this new competitive pricing, added to our efforts, will help us be number 1 in market share in the following years. Initially, Pacific Goods Incorporated was not very concerned with how the stock market went. Our main concern was our international expansion and the improvement of our operations. Once these things were stabilized, we decided to dive into the world of stock market. Our stock price had naturally risen since our company was growing at a steady pace. We entered into a stock repurchase program in year 5 with hopes of getting a stock valuation to go higher. This had a positive effect. Our stock price went up about $1 per year. The number obviously was dwarfed by Company 2's $8 stock price in year 5, but nevertheless, we are content with our own growth in that department. Our company was the first to establish operations in iStock. We took that leap with hopes of finding lower production costs. It was difficult at first since building a new plant can be very costly, but the payoff was definitely worth it. Throughout our history, we've been a leader in low production costs in the industry. It wasn't until years 5 and 6 that we lost the lead to Company 2. Either way, we kept our UPC within $1 of what we had predicted, so as a company we are very proud of that fact. In the next years, we will focus on increasing our training in order to further refine our production process and bring our UPC back to the number 1 spot in the industry. Pacific Goods Incorporated had the steadiest net income growth in the whole industry from years 4 to 6. Other companies had some troubling times and losses were experienced. We have always been an example of a steady growth company. Even though the price wars allowed others to sell more volume and create higher net income that way, we managed to keep our profits high while keeping our price steady. This is due to our heavy investment in training and advertising. We actually outdid ourselves by a huge margin. We had $1 billion more net income in year 5 and almost $2 billion more in year 6. We're very pleased with these results. We may have not only finished first in net income, but we believe that simply beating our predictions by that much is indicative of a bright future for Pacific Goods Incorporated.
Company 3 had planned out of having 15 salespeople in America 1 and in America 3, and having 14 in Americas 2 and in NYSTOC. However, the actual results for year-end for year 5 was 12 in America 1, 13 in America 2, 14 in America 3 and NYSTOC. For year 6, we had planned out on having 15 for all areas. However, we had many people resign, and we ended up having 11 in America 1, 13 in America 2, 3 at 14, and NYSTOC ended up at 13. Throughout these 2 years, we did not plan on raising the salary whatsoever. It remained constant. For commission rate, we had planned out on raising it about 10 to 15 points every quarter. The end result actually ended up being 40 for end of year 5, 135 in NYSTOC, and for year 6 it ended up being 50 and 145 in NYSTOC. For marketing, we had planned on keeping the prices at $10 for every quarter of years 5 and 6, and 75 in NYSTOC. During quarter 5, we noticed that sales started to drop in America 3, and we decided to lower the price to $9.75, which brought sales up a little bit during year 6. We then had to lower the price even further for the other areas, and decided to set them all to $9.75 and keep NYSTOC at $75. This really helped us to bring up sales once we had started Model 4. For year 6, quarter 4, we lowered the price even further to $9.50, and NYSTOC was lowered down to $72, which really increased our sales for the end of that year. For advertising, we had planned on raising it 10 to 15 points. The end results were actually completely different. We hardly raised advertising expenses. We didn't spend as much as we had planned on advertising. And then for sales to customers, that greatly changed when sales started dropping for America 3, and we had to start hiring more people and lowering prices and increasing commission.
Let us first talk about the R&D and model number. In our 2-year plan report, we estimated to spend $168,000 in year 5 and $0 in year 6 on R&D spending. However, the report shows that we'd only spent $121,000 in year 5 and $4,000 in year 6. It was because we saw Model 4 is ready to introduce to the market at the end of year 4. However, based on our strategy, Model 4 would not be released into the market until year 6, and therefore we slightly lowered the cost on R&D because we no longer need any new models after Model 4. During year 6, Model 4 had already been introduced, and we tried to zero out the R&D spending. However, the system shows that we could not pay $0 each quarter, and therefore we decided to spend $1,000 per quarter during that year, which makes a $4,000 expenses on R&D. As we can see, the model number we produced will match with our strategy. We produced Model 3 in year 5 in the market and Model 4 in year 6. Secondly, the training and cost saving levels. We were trying to gain more sales and to lower the production unit cost. We expected to increase our training expenses each quarter. However, the reason why the actual training expense in year 5 became less than our expectation was because we experienced an estimated output shortage compared with the estimated market demand. Therefore, we didn't raise the training as much as our estimation because we want to avoid any stock out. During year 6, we raised the expenses dramatically because we wanted to keep the unit cost low, which was a heavy weighted factor of our team. Since we kept increasing the training expenses and it let the cost saving levels increase by 1 level each year. In the total beginning inventory and total storage expenses, we're always afraid to experience any stockout since we tried once in year 3. Therefore, we expected to keep more inventories in our 2-year plan. Luckily, our actual data shows that we had way less stock than we expected without any stockout. And this also let our storage expenses become lower than expected. In order to decrease our total inventory, we tried to increase advertising expenses to attract more customers. However, the sales didn't gain too much. Finally, we decided to lower the price to raise the market share. We think that the cause of this overstock was because we overestimated our sales orders and the wrong model quality and features that sold in America 3. During year 5, we added 2 remaining lines in America 3, which makes a total of 8 lines in M3 and 6 in M4, in order to maximize our production output. We decided not to expand any other plants or lines afterwards because it might cost us more on plant construction. Rather paying for the second shift and plant expansion or construction, we decided to add the working hours from 40 hours to even 48 hours, the max in each lines. For both domestic and overseas production output, the variance were very narrow but slightly lower than expected. This is because of the sales orders dropped in those years due to an incorrect decision on the model quality and features. Also, we released a new model later than other companies. Finally, as mentioned, our market demand were lower than expected during both years due to some reason. However, we may see that it wasn't too low than our expectation, especially the units that shipped to sales office. Although their sales office in America 3 were less than expectation, the remaining 3 sales offers were still high. After we lowered our price from $10 to $9.75 and finally $9.50 in order to raise our market share, the units shipped to customer increased as well. However, the transportation expenses will also increase, although the total units shipped to sales office and customers were less than expectation in our 2-year plan. It is because we don't have any production plants in America 1 and 2. The demand in both areas were higher than our home plant. Therefore, we need to ship our products more than expected.
Okay, first I'll be discussing the income statement year 6 variance differences. I'll be discussing the variances that are over 25%. Our first variance that is over 25% is sales to customers. The sales to customers are lower than our actual. It's because we assumed a 5% growth assumption from the previous quarter. However, we sold more than we expected to because we actually lowered the price. We increased more in marketing than expected, and we didn't account for our growth strategy. Next time, we should assume a higher growth rate and use the correct forecasting template. Next, I'll be talking about less value-added tax. It's at a 51%. We didn't account for a higher tax deduction in NISTOC. We will fix this problem by accounting for NISTOC's higher tax bracket. Next, we have gross profit. Because our tax deduction was off by 51%, our gross profit is off by more than 25%. By fixing our sales and tax deduction, we can fix our gross profit. Next, we have sales salaries. We actually increased our salaries more than we forecasted to. Sales commissions, we didn't follow our decisions form when it came to sales commissions. We increased commissions dramatically to increase sales. We just need to follow through on our projected decisions next time. Next, I'll be talking about transportation expense, other expense, total administration expense, and storage expense. Because we didn't use the correct accounting template, we didn't grasp the full understanding of some of these expenses, which caused us not to project correctly. We used historical data, but learned that that wasn't enough to calculate the expenses. To correct this, we need to use the correct accounting template that was provided to us. Next, I'll talk about training expense. We went by our historical data to project, but we actually lowered training and focused more on commissions. We can't fix this, but just next time follow through on our original decisions. Operating profit. Our operating profit was off dramatically because our expenses were off. By fixing expenses, we should lower the variance of operating profit. CD interest. We actually pulled out of the CDs and didn't accumulate interest like we thought. We should have just left the CDs so we could accumulate interest like we projected. Next, we have net profit before and after tax. Because our sales and expenses and taxes were off, our net profit was not what we forecasted. To fix this, we need to fix sales, expenses, and tax rating so we can lower the net profits variance. Next, we have income tax. Because our tax rate was off, it affects the income tax. To fix this, we need to have the right tax rate and account for NISTOC's tax rating. Lastly, we have comprehensive net profit. Because of all the net profits before and after tax was off, it causes our comprehensive net profit to be off as well. By fixing sales and expenses, this should fix the high variance of comprehensive net profit.
Next is the balance sheet. Our biggest difference of variances in our inventory. Our inventory was extremely low due to the wrong forecasting method, but for our actual results, we fixed the solution by using the correct forecasting tool. If we knew the problem beforehand, we could have fixed our inventory. So therefore, because of our accounts receivable and our inventory being off by so much, our total current assets are above 25%, and we're fixing this. We'll fix that by using the correct forecasting tool. Next, our manufacturing and equipment. Because we had to add more lines to keep up with the sales, which were not projected correctly, we had a high variance in equipment. By projecting sales correctly, we fixed the large variance in manufacturing equipment. Our total fixed assets was off mainly due to the net equipment being off so much, which caused our total fixed assets to be off as well. By fixing the net equipment, we lowered total fixed assets variance. Our accounts payable was also off by so much because of the sales. We should fix that by just making sure that our sales are correct the next time. Our taxes payable was affected because of our tax bracket was off, and our sales were off so much, and our tax payable were off as well. We can fix the problem by forecasting better in sales with the correct template provided and by using historical data in the tax bracket. Our total current liabilities were off also by over 25% because of our accounts payable and our taxes. By fixing the two, we could obviously fix the total current liabilities. Our capital stock is the next variance, and it was off because of our forecast. We were to buy 100,000 in bonds, but we actually bought back more than we needed to because we were going based on the actual results in our game, and we didn't stick to our plan. Our accumulated earnings was less than we would have sold, and so therefore our earnings were lower. We can fix that by using the correct accounting template. Our accumulated foreign currency, we did not account for the currency adjustment, and we listed in our 2-year plan. However, we didn't list in our financial statements. And then lastly, our total equity is high in variance due to its buying back more stock than projected. This variance can be lowered by projecting what we would have bought back to sticking to the plan instead of having a different reaction to what the current situation is. Okay, lastly, the cash flow statement. Our first variance is in the accounts collected. This is off because we again didn't forecast correctly in sales, therefore ended projecting less money to be collected. And as mentioned before, we're going to use the correct forecasting tool, therefore we'll lessen our variance next time. Our taxes paid are also off because, as Justin mentioned earlier, we didn't account for NiStock's higher tax bracket. And therefore, we projected fewer sales, which obviously meant we collected less taxes. This will be fixed by using the correct sales projection. Our net operating cash flow is connected to sales. So because of us using the wrong projection, obviously it made our net operating cash flow expenses under accounted for. So therefore we didn't calculate the correct taxes, and therefore in order for us to solve this issue, we need to solve the previous two, which will correct the net cash operating. The net financing cash flow is actually bought back more stock and bonds than we were projected. Therefore, we created this higher variance. Next time, our decision form, we should project more bonds and stocks to be repurchased if we want to get the results that we got. The whole entire financial statements were greatly affected by our sales forecast being incorrect, therefore creating a ripple effect within all of our statements. By using the correct forecasting tools, which we did ensure in the middle of the game, we had higher results that were more positive than negative. In the future, for the years 7 and on, by using the correct tools, we will be able to have less amount of variances within our financial statements. Thank you.
The strengths of Pacific Goods was cash, sales, kept the prices consistent, and we also had the first model advantage. First off, Pacific Goods was having excessive amounts of cash quarter after quarter. The company was selling all it was producing, which was bringing in cash consistently. The company never stocked out since it produced just enough to satisfy customer preference. Pacific Goods was maintaining exactly what customers wanted. Our product was a need more than a want, so customers kept coming back to purchase units, which generated sales. Due to the amount of money Pacific Goods invested in advertising, there was a trend that it boosted sales every time more money was spent on advertising. Kept our prices consistent. Pacific Goods decided to not focus so much on extending the features and quality of the product and only release new models of the product from time to time. Since this wasn't a company strategy, that meant the price of each unit must stay consistent every quarter, and it did. The company kept the price at $10 until year 6, quarter 3, dropping the price at $9.75. In year 6, quarter 4, the price dropped at $9.50 because the company wanted to be price competitive with the other companies. First model advantage, Pacific Goods was the first to go overseas to NiStock to produce and sell. It was a successful move because the following quarter the company noticed a boost in sales, and it was the reason why the company was able to keep unit costs so low. Shortly after, the rest of the companies began to expand overseas as well, but by that time customer preference and loyalty was already with Pacific Goods Incorporated. Weaknesses for Pacific Goods was equity, slow expansion, and quality of features. Even though Pacific Goods had a lot of cash, the company was not investing in a lot in stock like it should have. Pacific Goods also did not take out any loans, so it had not fallen into debt, which meant that it was not paying back any kind of loan or debt. Slow expansion. Pacific Goods focused on not investing a lot of money into the latest features at first because it wanted to keep costs low and affordable for consumers. However, when Pacific Goods started realizing it was losing market share, they found out it was because the competitors were investing a lot of money in R&D and coming out with the latest model and features faster. Sales were then affected by this and began to decline. Quality of features. Due to Pacific Goods' strategy of keeping the model it releases simple and not making the product expensive for consumers, it lacked on the quality of features. The company was not trying to be a high-end product in the market, which is why it was not spending money on the latest features and always releasing the latest model when available. In the market, companies were releasing the latest model and features, therefore Pacific Goods fell behind. Opportunities for Pacific Goods are market share, stock price, and research and development. Market share. An opportunity Pacific Goods has is to increase its market share by becoming more competitive with the rest of the companies. That will mean spend more cash on R&D and advertising. Also, investing more cash in stock. The cash was only sitting there when it could have been used on investing the company for future sales and growth. For stock price, like market share, stock price was also being affected. Pacific Goods' decision to invest in paying out dividends should have been one of its priorities and looking to keep investors and shareholders happy. Research and development, the cash Pacific Goods had should have been invested a lot on research and development. To be more competitive with others, the company should have been coming out with the latest models first and added the latest features as soon as they were available. Threats for Pacific Goods are nice stock barriers and economic downturn. Pacific Goods had the first mover advantage before the other companies and were the only company who were producing outside of America, holding full production compatibilities and costs in nice stock. The appealing strategy is attractive for other entrants, which result in them to enter the market in nice stock. Economic downturn. The economy affects consumer spending and there is no way to control the economy. Pacific Goods strives to be affordable to the consumer, but the economy can get to a point like the recession where Pacific Goods products will no longer be affordable anymore. This will obviously affect sales since consumers will be more conscious on spending. Year 7 projections. For the upcoming year, Pacific Goods plans to expand its sales in America 3 and nice stock. For M3, it has become clear to the company that a standard quality product is not particularly in demand. Sales data show that a premium quality model with quality features is the most demanded in this region. Pacific Goods will invest $100,000 in conducting a market study in M3 to determine what product offering would appeal most to the market, while maintaining Pacific Goods' position as a provider of affordable consumer durable goods in the area. When the product offering for M3 is decided, Pacific Goods plans to expand 20% of prior quarter regional sales on marketing efforts to boost product demand, starting with a cash expenditure of $274,800 in year 7, quarter 1. To boost sales in nice stock, Pacific Goods plans to invest in advertising by 20% prior quarter sales in the region and 10% sales commission. We noticed that when more money was spent on advertising and sales commission, there was an increase in sales. For example, in year 6, quarter 3, our total sales were $677,300, and in year 6, quarter 4, sales boosted $916,200. That was because the last quarter we spent more money in advertising. That will also mean we should hire more salesmen and have salesmen compete with one another for commission and boost sales. A lesson learned after playing the game is to invest money in stock and paying out dividends to stockholders early on when we started to generate revenue. We were not paying out dividends in the past quarters, which resulted in having a net financing cash flow of negative $133,000 in year 6, quarter 3, and negative $50,000 in year 6, quarter 4. We would have definitely have to raise that number in year 7 so it can be positive by investing a stock and paying out dividends. Another lesson we learned was to pay attention to how many people are hired and working in the plant. We did not realize we had so many people working in nice stock plant at first, 14 salespeople. In year 3, quarter 1, that was a lot because we had just started production, so there was no point in having so many salesmen in nice stock. We didn't know, but we were hiring a salesman in nice stock every quarter by one. Until we finally realized it, we then dropped salesmen and added as needed. Sale revenue is what determined the number of salespeople. The last lesson we learned is to find consumer preference from the beginning before production. We should have spent more money in research and development from the beginning to really know what consumers wanted in the industry. We decided to start off by the strategy we set for the company and then later purchase the consumer report. Pacific Goods should have invested in the consumer report and R&D from the beginning and know and understand customer preference. The method to fix the three mistakes Pacific Goods made is by utilizing strengths, minimizing weaknesses, taking advantage of opportunities, and avoiding threats. Pacific Goods selling an affordable product and keeping the unit cost per unit low makes the company the low production cost leader. Since operations are kept at a low expense, Pacific Goods is able to keep prices low while still being profitable. Minimizing weaknesses. Our biggest downfall was not investing the cash we had into stock or paying debt to boost the company's equity. Pacific Goods should have invested more money into stock and pay shareholders back and keep them happy, and to avoid having all the cash the company had. Holding cash in a company loses the dollar value, therefore we should have invested it in stock. Taking advantage of opportunities. To increase market share, we should have expanded more. We should have opened up more plants in iStock to stay competitive with the rest. We also should have produced better quality feature products and been a higher end product rather than staying as an affordable product and playing it safe. We should have took risk at testing out different models sooner than the rest and always stayed being the first mover in the industry. Avoiding threats. It is impossible to control the economy and have consumers have disposable income to purchase our product every quarter. We also cannot control the number of entrants into the industry. However, we can focus on building brand loyalty and equity in order to defend ourselves against the threats that the company faces. Pacific Goods has market share, and to keep it, we would have to continuously come up with solid strategies to stay competitive with new competitors. We can spend more money on research and development in case the models are not successful in a timely manner.